Hi, Dr. Cradle. I'm creating this video to give you an overview of my dissertation. My thought is that I can direct you to the main points and you can look more carefully at areas that you identify as important after I explain some of the basics. So I'm going to go ahead and share my screen here. And I am going to pull up my dissertation, which you should be able to see. Okay, so I'm just going to walk through 330 pages. So I'm going to give you the highlights, and also you may get a good understanding of my intention with each of these points as I put my spin on how I'm explaining it. All right, so the value of information content in IFRS financial statements. As you know, that is my topic. Committee page. So since you and I last spoke, I've been in touch with Dr. Finley about a couple of issues that have come up with the dissertation committee. As you know, there was concern about Dr. West being a former faculty member, and now she is considered an outside faculty. And then in terms of Dr. McLean staying on the committee, Dr. Finley, she and I didn't really talk about it. She just said he's no longer going to be able to continue as an internal member, even if we did it rushed, tried to do it during the summer. So with those two things, Dr. Finley was very, very helpful in introducing me and getting me connected with some other folks who have agreed to be on the committee. And they are Dr. Gerard Hall. I spoke to him. He's excited about working on the committee and excited about the topic. As you know, Dr. Leslie West was originally on the committee. She's going to remain on the committee as an external member. Dr. Lee Young, she's was the original externl member. She's my colleague at Mercy College, PhD in finance at UT Austin. And she's been an important mentor and an important person for me to conduct my research with over the last year. And then Dr. Benjamin Thompson is going to be joining the committee in place of Dr. McLean. So, all right, so that's the committee as it stands right now. All right, we've got table of contents. Or abstract. Okay, abstract. Wait a minute. View sidebar. So I'm going to bring this this sort of heading list is a way of guiding us through this discussion. I've got so many different headings and subheadings, and I think they're going to be helpful to you as you try to pick through this. But let me go back then to where we were. We're starting at the abstract. So value of information content in IFRS financial statements. This abstract is, I think, a really good summation of everything in the dissertation. It talks about how IFRS is used by the vast majority of jurisdictions. There have been some very impressive results about the implementation of IFRS in terms of positive results for market outcomes and accounting quality. There's also been this recent development in Japan where investors, or excuse me, companies are allowed to use both IFRS and local Japanese GAAP. And there's been very little research about which accounting standard is producing financial statements with the highest value of information content. So a gap and critical opportunity to do testing in Japan, IFRS. Methodologies used are based on the classic Ball and Brown 1968 and Beaver 1968. These two studies were the foundation of proving value in financial statements, and they continue to be very influential methodologies today. Okay. All right. So the results are Japanese companies that use IFRS have a higher value of information content via the Beaver methodology, which is trading volume. They also have a higher value of information content via the Ball and Brown method, which is looking back over a period of 12 months prior to an earnings announcement and finding the association between surprise earnings and abnormal return. And then there's a close analysis of how you measure that surprise earnings in this dissertation, which I think strengthens the dissertation. The Ball and Brown tests do not withstand a bootstrapping procedure. So the value relevance says the IFRS firms in Japan are better, have higher value relevance. But I also conducted a bootstrapping procedures, which was one of very few ways to try to determine a statistical difference. And that produced some gray results. So I'm at a point where I say that Ball and Brown suggests better information content. But that taken with the whole mosaic of evidence of the other tests and the literature support a finding of IFRS superiority in Japan. This result is the first known empirical test comparing accounting standards in Japan. There just wasn't a lot of literature about Japanese accounting and well, there's lots of literature about Japanese accounting, but there wasn't any literature testing the results. There was some literature which tested the anticipated results. What were the market reactions when firms in Japan announced they're going to be implementing IFRS? But in terms of which statement is better, I could not find really any studies that are looking at it. So there's that finding, and there's also very interesting finding, which was one of the methods I used to measure surprise income, surprise earnings, was a measure based on analyst expectations that was a qualitative variable. So it's a question, did earnings beat or miss expectations? That particular variable had the highest, strongest correlations throughout the testing. And there wasn't a lot of literature that supported the use of a qualitative variable. And my research indicates that's very strong, which could be a contribution to the information content literature. And also the fact that the analyst expectations were so strong may also be a value add of this dissertation. And that may be related to the fact that my Bloomberg source was, my data source was Bloomberg, and Bloomberg has very high quality analyst expectations information. All right, dedication. Acknowledgements. Of course, Dr. Credle is acknowledged. Thank you for all your guidance and leadership. Table of contents. All right, so I've got the table of contents here. I want to make one note. There's so many headings, so many subheadings, and I'm going to explain how I keep track of them all in the navigation tab, and you can keep track of them as you're working your way through. This table of contents is not yet in APA format. There's some things that I want to iron out as I work with you and the rest of the committee. So forgive that, but it is in a very clear form. In addition to the table of contents not being in APA yet, the list of tables that follows. So that's the table of contents. Here's the list of tables. This is not in APA format yet. There's just a few things that need to be worked out as I discuss them with you and the rest of the committee. But I think it's all very clear. And the way I think you're going to be able to navigate through this is using a navigation pane on the side. All right, so this is the way I have managed everything. And how you look at this navigation tab, suppose it weren't up, if you just open up this document that I emailed you, you would go to View, Sidebar, Navigation, and these headings and subheadings would come up. I like to go in here, right click, just click on one of them, right click, go to show heading 1, and then you can expand them out as necessary. All right, so that's view, sidebar, navigation, and then you're here. So I briefly went through the abstract and all of these things. Let me now start then with the introduction. So the introduction starts with an overview of IFRS, essentially saying the successful implementation of IFRS in so many jurisdictions. There's of course going to be some discussion about the drawbacks, disadvantages, and why some jurisdictions, for example, the United States, have not fully embraced IFRS. The introduction then proceeds with a brief overview of the history of IFRS in Japan, which was a discussion about convergence in Japan between Japanese GAAP and IFRS. Then it was a discussion about whether or not mandatory adoption should take place. And then it was a discussion about mandatory adoption being on pause, but let's allow for voluntary adoption. And that's where Japan is right now. Companies are voluntarily allowed to use IFRS or Japanese GAAP. And we're going to assess the results of that. And Japan being essentially the one place, the only jurisdiction where there's a prevalent use of both IFRS and the local standard. There are a few other places where multiple accounting standards are allowed, but Japan is the only developed country that uses a good chunk of 2 different standards. IFRS in Japan and the need for empirical testing. Okay, so there have been very few studies actually testing the results of this experiment. All right, so the introduction then moves on to the importance of the value of information content. So this is an explanation of the studies in 1968. They're going to be discussed in much more detail in the literature review, but this is just introducing and explaining the idea that accounting statements have value. If we didn't have those seminal studies, then we wouldn't even be at a point where we could say one accounting statement standard has more value than the other. It's because this proof of the importance of value of information content based on these studies that gives us that opportunity to have that discussion. So it explains those seminal studies and a little bit of how those methodologies are still relevant today. Okay, then overview of dissertation sections is the last section in the introduction. Chapter 2, literature review, methodology, results, conclusions, and just kind of gives some highlights, just high-level highlights. All right, so that is the introduction. All right, and then we get to the literature review. There's so many, like when I thought of trying to just throw this literature review at you, and the thought of like all the different components of the literature review is one of the reasons why I wanted to create this video to go over all the different parts and just present them. So literature review is going to contain a lot of literature about IFRS. It's also going to contain a lot of literature about the 2 methodologies used, Ball and Brown and William Beaver. It's also going to contain a lot of literature about Japan, both the basics of the Japanese economy, as well as the literature that tests accounting value, accounting statements in Japan, as well as a lot of literature about what would be the appropriate sample pools to use for testing in Japan. And then I should also add that there is a variety of information about the United Kingdom, because as I will explain in a moment, the first testing step was the United Kingdom. All right, so literature review. Overview of IFRS use. So let's talk about benefits. I have here one standard and other benefits. One standard being the idea that if the world is on one standard, we have a comparability issue and familiarity issue, which everyone benefits from, and other benefits, including, so we've got comparability, quality, trust. All right, so we're still on overview of IFRS use, drawbacks. All right, what are the drawbacks? Well, this section goes into that. Control is a key one, and this has gotten a lot of attention in the United States. The SEC says, no, we're not going to give up control of enforcement. And also the US is reluctant to give up control of creating new standards. Flexibility, right? This could be a benefit or a drawback, and it's discussed essentially in both contexts, but it is more often referenced as a drawback. Quality, okay, so with increased flexibility comes the risk of lower quality. Now, there's a flip side to that argument, of course, which is discussed in the benefits, that the increased flexibility gives the opportunity for more accurate accounting statements. But if the flexibility is not properly enforced, then we could get lower accounting quality statements, or lower quality accounting statements. Okay, so where are we? We're on drawbacks. Okay, so now IFRS and Japanese accounting characteristics. Okay, so this is a brief discussion on, well, if we're going to evaluate Japanese GAAP versus IFRS, what are some of the differences that we might be looking for that would be providing more or less value? And the key one mentioned in the literature is the fair value accounting issue, where IFRS allows for fair value accounting, Japanese GAAP does not. So that could be either the difference in increased information content value in IFRS or lower quality in IFRS. So that's what our test is going to shed some light on. And there's a couple other things referenced in the literature, none so prevalently as the fair value accounting. All right. So that is going to bring us then to the literature findings of IFRS. So we've gone over the overview of IFRS. Now we are at the literature findings of IFRS. So what are the literature findings? All right, so it's not just Japan, this is everywhere. Well, the findings are that we have superior market outcomes with IFRS implementation, and we have superior accounting quality with IFRS implementation. So on the whole, we find superior outcomes. However, and that's going to be discussed in this section, findings of IFRS superiority. However, there are a number of studies that find inferior outcomes. So these studies are assessed and they are categorized based on the reason for the finding of inferiority. And these are categories that I created as I looked through all the literature and read overall assessments. So essentially the way this subsection works is we've got a discussion where I assert that the overall finding based on meta studies, based on studies that look at lots of countries, or based on studies that look at lots of other studies, based on individual studies, that we have superior outcomes for IFRS. How then do we reconcile these inferior findings? Well, we look at why they may have occurred. Why might we have found a bunch of studies that find poorer outcomes for IFRS? All right, well, how did I break those down? I put them in three categories: familiarity, enforcement, and mandatory adoption. So maybe the study found IFRS was inferior because they were used in a market where the users of the accounting statements were just not familiar with IFRS. And that's why the trading volume is different, or the value relevance wasn't as strong. Enforcement, number two. All right, this is a key issue. So and there's a whole bunch of different complications with enforcement, which I'm going to get into when I open up that subsection. Number 3 is mandatory adoption. So if we voluntarily, excuse me, if a country says to firms, you are voluntarily allowed to use IFRS accounting statements, then you might suspect that only firms that would benefit from IFRS would adopt IFRS. Right? So you have a study where there's voluntary adoption, and you say, oh, look, all the firms there had better market outcomes, better accounting quality. Then you have a study where you force everyone in the country to adopt IFRS, and you have inferior outcomes. Or that's because there was potentially a self-selection bias in the voluntary adoption sample. So this is a critical potential weakness to IFRS implementation. So, and there were studies that found mandatory adoption results in lower accounting outcomes, lower quality. So these 3 issues, the familiarity, the enforcement, and mandatory option, could be looked at one of 2 ways. You could say, well, 1, that's just the reason why they found inferior outcomes. Or 2, you could say, well, we need to test more carefully in each of these 3 areas. And that was the first step in this dissertation research. I tested mandatory adoption in the United Kingdom. Okay, so before I get to those 3 sections in a little more detail, let me just explain this short statement on US GAAP. So there are a few studies which evaluate the content or information content of US GAAP and compare it to IFRS. And really only 2, actually. And both of those studies find US GAAP to be superior. That there just wasn't enough literature to really include that as a potential weakness of IFRS because there are only 2 studies. But it is worth noting, and it is worth considering possible future research will be conducted in this area. Okay, so where are we? We're looking at the IFRS literature overall. We said basically IFRS, the preponderance of the research evidence shows IFRS is superior. There's a short statement on US GAAP, shows something different than that, but there's only 2 studies that we really can't use in our findings. So then let's look at all these findings which say, yes, IFRS is better. IFRS is superior. Bunch of studies here. All of these you can work through. Most of them are explained succinctly. Some of them are explained in more detail because of the importance of the methodology that these studies used. But again, the finding of IFRS superiority is supported by these studies. Okay, then we have this issue. Some of the studies show inferior outcomes. Why do they show inferior outcomes? Well, these 3 reasons. Familiarity. Maybe we're in a market where investors are not familiar. So these studies show inferior outcomes. Or early adoption. Maybe a country in Europe like Finland said, all right, we're going to adopt IFRS before everyone else did. And those accounting statements were not as value relevant or were not as useful based on the Beaver trading volume methodology because investors were just not as familiar with them. Also, there's a whole bunch of studies here, foreign market dependent variables. So these are by and large earnings reconciliation studies of foreign companies that are trading in the United States. Those countries prior to 2007 were required to do a reconciliation, and these studies found that there was value in that reconciliation. And then the argument was, well, if there is value in a foreign firm reconciling it's IFRS accounting to US accounting, then that's evidence that US accounting has more value. So there are a couple problems with that. One is that, well, we're looking at this in a foreign market. Also, it's not necessarily an apples to apples comparison. So if you have this reconciliation, it's either going to be valuable to some people or not valuable to other people. Valuable to some people, not valuable to other people. And if it's valuable to anyone, then you're going to see some value relevance. But that's not a direct comparison between IFRS and US GAAP. Some of these studies try to overcome that, and I talk about some of the ways that they do that. But those are findings of inferiority explained in terms of familiarity. Okay, enforcement. Now, enforcement, a huge issue, largely complicated issue. I'm going to take a crack at overviewing it right now. Obviously, it may be an issue that's important that you want to read more carefully on in each of these sections. But ultimately, in my dissertation research, enforcement is, the question of enforcement is avoided, essentially. Because in the third and final step of my research, which is research in the Japanese markets, I'm looking at the value of information content of IFRS firms versus Japanese firms in the same market, on the same index, in the same year. Thus, enforcement is held constant. So the firms that chose IFRS and the firms that chose Japanese GAAP, they faced the same enforcement environment. So with that control, the expectation in my study is that improper enforcement in one group of those companies is not going to bias the results. So that's in my research. But in the IFRS literature, it's interesting to note that there have been a lot of studies that indicate that, that this can be an issue. And it can be an issue actually, so 3 ways. Let's look at this. Inferior outcome for IFRS attributed to enforcement issues. Okay, so these are countries where enforcement was poor. So we may have had flexible accounting, and the accounting authorities are not able to enforce proper usage of those flexible standards. So you give the accountants more flexibility and they abuse that. And we have inferior outcomes attributed to enforcement issues. We also have a few studies that say superior outcome for IFRS contingent on enforcement. So this is essentially the same thing. It says, our study found that IFRS has superior outcomes, but but the countries that had better enforcement have more superior outcomes. The countries that have worse enforcement, they have maybe just, almost as good, maybe a little worse. It's contingent upon enforcement. Third, and perhaps most interesting, is this unstable effect of enforcement. So I mentioned a minute ago, some of these studies say if it's a strong enforcement environment, then IFRS is more likely to be successful. But here are a couple studies where a strong enforcement environment is actually a disadvantage. Canada, known to have a strong enforcement environment. When Canada implemented IFRS, the accounting quality went down. The researchers suggest that one of the reasons that might have happened is because the strong enforcement in Canada was geared towards the existing accounting statements. So when you have a switch, you have something of an enforcement lag. It's almost like strong enforcement works against you in that case. All right, so third kind of way to look at this enforcement issue. All right, and then the fourth section here is a little discussion on the Foreign Corrupt Practices Act and its implications. This is because readers of this dissertation may be interested especially in how this enforcement issue plays out in countries that are not the United States, where we have the Foreign Corrupt Practices Act to curtail unethical bribery, and in fact, bribery that might even be put on the actual accounting statements. And again, this issue is factored out of my research in Japan because I'm using Japan as a controlled environment. And also, incidentally, I'll explain later, Japan has support for having a strong enforcement environment. But still, this is interesting to look at how other countries deal with corruption issues, deal with bribery issues. Some interesting discussion here. A number of reasons why bribery in other countries has decreased. Sometimes it's just outright stated that bribery is against the law and bribes cannot be put on accounting statements. For the most part, it seems that putting actual bribes on an accounting statement is a thing of the past, but there are still, it seems, ways that some countries get around that. And there is, of course, the issue of, well, if you're not enforcing it, people are just going to break the law, bribe people, and you might not even be able to recognize that it is on their accounting statement. So some interesting discussion on what happens in other countries and some reasons why enforcement might be an issue that corrupts the value of accounting statements or corrupts the value of IFRS implementation. Okay. All right, and then enforcement conclusion. I think I've explained all this, and also I've explained that I am going to control this issue with an isolated study in Japan. All right, mandatory adoption. What do we got here? Yeah, this is just mandatory adoption. So this is just one category of reasons why IFRS results in inferior outcomes. So my first step, the first thing I did was look at accounting statements in the UK, which had mandatory enforcement in 2005. So if I had found that IFRS improved the value of information content, which I arguably did, but it was just a little gray, and so I decided to move on. If I had found that clearly, and we're going to state that in my dissertation, then this would be support of IFRS superiority, and also it would be looking at one of the gaps in the literature, which says, well, mandatory adoption doesn't always result in superior outcomes. All right, so that's mandatory adoption. All right, so those are the overall findings of IFRS literature. Now let's look specifically in Japan. All right, so testing IFRS, oh no. All right, so we're gonna start with IFRS in the United Kingdom. So there's mandatory IFRS adoption in the United Kingdom. And as I mentioned, this was my first research step to try to fill that gap, to explain the effect of mandatory IFRS. What have I got here? So this is kind of a quick and dirty. Let's look at the UK. Let's look at the fact that it's a global economy. Let's look at a good place to test, or a good thing to test, which was the FTSE 350, which is highly representative, represents 95% of the entire market capitalization in the United Kingdom. And let's use the US markets as a control group, and let's use the S&P 500 as the control sample. So this is explained pretty quickly because this was ultimately not the conclusion, or I'm not resting my dissertation conclusions on these findings. So it's explained what I did and why I did it somewhat briefly. And then we move on to accounting research in Japan, which is the second and third step. The second step is a sort of broader look at Japan. Third step is a look at a more specific sample with the Nikkei 225. So accounting research in Japan, we need some explanations of what's going on in Japan. So let's look first, characteristics of the Japanese economy. Export-based economy, asset bubble in 1991 that burst, and the economy has stagnated since then. New accounting standards is certainly related to attempting to generate more momentum for the Japanese accounting, or the Japanese economy. And there is, of course, a discussion about whether or not it would, which is what we're doing in this dissertation, trying to get some results. Okay, so the first testing pool is the Tokyo Stock Exchange. I tried to test essentially every stock on the Tokyo Stock Exchange. So I explain what that is, why that would be a good thing to try to test, because it is representative. 90% of securities in Japan were conducted on the Tokyo Stock Exchange when the market was booming. Still the primary stock exchange in Japan. The third step of this dissertation research looks specifically at the Nikkei 225. The thought here is that the Nikkei 225 would provide a more consistent sample. So there are very specific requirements for stocks to be on the Nikkei 225 in terms of size, number of shares outstanding, assets, and those characteristics are monitored carefully each year. And if a firm does not meet that minimum standard, they're removed from the index. So the idea is that firms on the Nikkei 225 that choose IFRS and firms on the Nikkei 225 that choose Japanese GAAP would have similar characteristics and result in a fair comparison. That is one advantage of using the Nikkei 225. Other advantages of using the Nikkei 225 are that it is known to be highly representative of the Japanese economy, leading most well-respected index. Information is consistent. A lot of good information as I pulled this data from the Nikkei 225. Very rarely any of the data I got from the Nikkei 225 looked weird or was missing. Everything was there. All right. There is going to be one concern later on in this dissertation about whether or not the proportion of industries is the same for the firms that choose IFRS with the overall Nikkei 225. And I conduct a proportion test and find that it is essentially essentially the same. It's different, but there are no systematic differences, with the possible exception of a high representative of healthcare industries that chose healthcare firms that chose IFRS. And I'll explain more on that later on. All right, so Nikkei 225. All right, so this is just the background on the economy and the sample pool I'm using. The IFRS experiment in Japan. So let's talk about the steps of convergence. This is a discussion about converging IFRS with Japanese GAAP. Then there's a discussion about should IFRS be mandatory in Japan. Then there's a discussion about no, it's not going to be mandatory, at least for now, but it is going to be voluntary. What are the expected benefits? Well, the expected benefits of IFRS in Japan are similar to the overall benefits of IFRS in the whole world: comparability, quality, trust. A review of individual studies indicates such and such. Oh yeah, here it is. All right. So the Japanese literature most commonly cites the benefit of international comparability. So in addition to the overall benefits of IFRS, the literature that's going to be quickly reviewed here says that Japan is expecting possible benefits from international comparability. Discussion of that ensues. All right, and then we have the interesting question. All right, so comparability is going to be the benefit, but who specifically is going to benefit? Is it every country that's going to benefit? Excuse me, is it every company, every industry? Well, it turns out we have an expectation essentially that international companies, all right, so we've got overall, we've got higher proportion of foreign shareholders and companies that are more motivated to share information with investors or potential investors overseas are expected to benefit. brief explanation of those specifics. All right, in this market evidence of IFRS benefits. Okay, so this is really the only empirical testing that I could find in Japan. There are a number of studies that said, okay, this company just announced that they are going to voluntarily use IFRS. So what's the market reaction? All right, the market reaction is positive. So that's what these, I believe, 2 studies indicated, that companies voluntarily announce they will be implementing IFRS, stock prices go up. There's no empirical results of the actual results of using IFRS. There's just results of the expectations. All right, and of course we have drawbacks. And of course there's the normal drawbacks of IFRS, but what did the literature say about drawbacks in Japan? Well, it said a couple things. Manufacturing companies. Manufacturing companies were concerned about the fair value accounting aspect of IFRS and fluctuations in the price. There's also some interesting discussion here about just kind of the nuanced inner circle accounting environment. The word secrecy was mentioned in a number of these articles, that the Japanese companies are, the suggestion that Japanese companies are okay with the historical cost model because everyone in their inner circle, including banks that they trust and professional relationships they have with other companies, will know. Right? They'll know that, all right, that that manufacturing plant we purchased 6 years ago, it has fluctuated in value, but the important people know, and we're reluctant to see that fluctuation and share it with the whole broader market. So in addition to manufacturing concerns, we have issues of, well, kind of, we're gonna share things that we already share with people who are important to us, and we're not sure that we're comfortable sharing it with others. All right, and also the flexibility aspect is not something that was expected to be well received in the rules-based accounting culture in Japan, and that may have affected companies who are trying to get capital from inside Japan, or may have affected them negatively. All right, so drawbacks, so discussion on the drawbacks. All right, so now let's talk about the literature review in Japan. Okay, so essentially everything I just said about this IFRS experiment in Japan is covered in this literature review. So here are the key studies that were reviewed to gather that information about steps in convergence, benefits, expected beneficiaries, market evidence of IFRS benefits, and drawbacks. Again, this is stuff that was important for me to read, analyze, and if you need to the extent that you need to, you can go through each of these studies. All right, so then that is going to bring us to the methodologies. All right, so we've just, what have we discussed so far? So we've discussed, let me close up just to keep everything straight here. All right, so we've discussed in the literature review, we've discussed the overview of IFRS, the literature finding of IFRS, superiority with caveats that we can explain. And then we've talked about mandatory adoption of IFRS in the United Kingdom, how that might be a good thing to test. And then we've talked about the accounting research in Japan and how that might be a good thing to test. So the question is, how are we going to test? What methodologies are we going to use? Well, there's 2 lines of methodology. One line of methodology is based on Ball and Brown, 1968, and the other methodology is based on William Beaver, 1968. Now, both of these methodologies, they're not used in exactly the same way as they were in 1968, but there are some strong similarities. The original work of these 2 studies has evolved into contemporary methodology, but the key basis is still there. So for each of these, there is a review of the original study, there's a review of studies that came after it, and there is a review, or not a review in this section, but there are sort of a summation of studies back in the literature review findings of IFRS that use these methodologies. Okay, so Ball and Brown. Let's look at the original study. Let's go through it. And there was also a reflective piece in 2014 that Ball and Brown conducted, which provided some really interesting insight in terms of what had happened and how their studies had been received and how the methodologies evolved from between 1968 and 2014. All right, studies that followed Ball and Brown. All right, so these are studies that replicated or expanded the information content study of Ball and Brown. And there's a bunch of them that are reviewed. Some of them replicate, some of them add other factors. They say, let's look at different ways which we can, actually, let me briefly explain here. All right, what was Ball and Brown? And I know you're very familiar with Ball and Brown, but let me just explain the highlights so that I can provide a context for what these following studies built upon. So Ball and Brown said there is a strong correlation, a strong relationship between earnings and price. Now, specifically, they said, well, what about earnings has value? If a company has an earnings announcement and says, this is how much money we made, what is valuable about that number? Well, it's the surprising component, because if everyone expected a $10 million earnings profit and you have a $2 million earnings loss, right? It's the gap. It's the difference between the expectations and the reality of the announcement. Now, that information is likely to have filtered out, possibly very ethically, just other sources of information. So there's no there's no market reaction typically on earnings announcement. So prior to 1968, accounting researchers said, well, there's no value in accounting statements, because if you look at an earnings announcement, the market doesn't care. Ball and Brown says, well, you have to go back 12 months and look at the correlation between earnings and price over the previous 12 months, and you will see that information reflected if you look back, because it's not timely, but it is relevant. It's highly relevant. Okay, so what did these studies that follow Ball and Brown do? Well, they said a couple of things. They said, well, let's look at a different way to measure surprise earnings. So surprise earnings is the part that's valuable. Well, let's measure it based on an analyst expectation. Let's measure it based on a drift adjusted expectation. Maybe let's measure it based on a qualitative variable versus a magnitude variable. So that's one of the things that these studies that followed introduced. The other is the idea of control variables. They said, well, all right, so we've got surprise earnings and we've got a relationship between the earnings and the market, but what if this is a company that nobody knows about? All right, is that going to change how much value there is in this earnings component? What if we look at qualitative variables versus magnitude variables? I think I said already. A bunch of control variables. So I think Fawad and Foster look at earnings estimate. If management releases earnings estimates prior to the actual release, how is that related? Maybe there's analyst forecast, Griffin, Firth, competing firm. So if a competing firm is going to release its earnings announcements, how is that going to be related to the value of a different firm? So a bunch of evolution in this, and that analysis is going to bring us all to the contemporary use of Ball and Brown. So we've reviewed all these studies in Ball and Brown. Now let's look at the contemporary use of Ball and Brown. Regression analysis. So that's the big difference. Ball and Brown did not use regression analysis to determine how much value there is in, how relevant is earnings to return. They used a different method, and the contemporary studies all use regression analysis. Abnormal returns. Okay, so I've mentioned a lot about how we're measuring earnings, how we're going to measure surprise earnings, but what I've not mentioned is how we're going to measure return. Is it going to be the raw return, or is it going to be the abnormal return? Well, this is not really an issue because Ball and Brown always said abnormal return. Pretty much every study that came after it said abnormal return. And with the acceptance of the capital asset pricing model, that's just been essentially what every researcher uses. Annual earnings announcements. There is some question, do we use earnings announcements that are annual, or do we use earnings announcements that are quarterly or monthly? Well, annual earnings announcements are still the standard, accepted, used initially by Ball and Brown, and still used. And even as investors gain in sources of information, even as they gain a stronger understanding, the Ball and Brown method of looking at annual earnings announcements will still work because it's reflective, or I don't know if reflective is the best way, it's retrospective. That's what word I'm looking for. So it goes back 12 months and says, well, what happened over the last 12 months? We don't care what happened on announcement day. We look at what happened over the last 12 months, and it doesn't matter how many sources of information an investor had. We would still see it from the beginning of that time period covered. Okay. All right. Then I mentioned determining the valuable component of reported income. So how do we measure surprise earnings? Like, what is valuable about that earnings metric? Well, this is worthy of its own section. So here I have a discussion, support for specific income expectations. So we're not going to look at just raw income. We're not going to say, well, all right, the company made $12 million. That's the number. Well, it depends on what the investors were expecting. If the whole market went up by 5% and all companies were expected to earn $20 million and your company only earned $10 million, then that $10 million is not a good thing. It's actually a bad thing. So there's support for looking at specific income expectations. And the most specific way is an analyst expectation. And that's what I ultimately use in this methodology, in this dissertation. There is some support for drift adjusted models. So there's some support that, well, let's not look at a highly specified model that an analyst would make. Let's just look at the overall market income, because the highly specified model based on the analyst expectations could be over specified. They could try too hard, they could get it wrong. So if we just look at a drift, then we will, then we'll get the key component. And I do test for both. I test for analyst expectations and drift expectations. All right, the support for magnitude variables versus the case for qualitative variables. So magnitude variables, so this is measuring earnings in terms of percentage, which is probably what you were thinking of to begin with, which is what all the contemporary studies do. They say, well, what was earnings last year and what was earnings this year? So earnings went up by 4%, 5%, 6%, went down by -1%. So that's the magnitude. What percentage did it go up? What percentage did it go down? Qualitative variables is just, did it go up or did it go down? Or if we're looking, and that's if we're looking at naive income, if we're looking at drift adjustments, we say, well, did it go up more than we would expect for the overall market? And how much more? 1%, 2%, 3%, that's the magnitude. Or if we're looking at analyst expectations, did it beat analyst expectations? Well, it beat analyst expectations by 1%, 2%, so on. That's magnitude. Qualitative is different. That's just, if we're looking at analyst expectations, we'd say, Did the reported income, did it beat expectations, positive, or did it miss expectations, negative? So these are two ways to measure this earnings surprise and categorize it and then run your regressions. It turns out that magnitude variables are more often used in the contemporary studies, but I found in my test across the board that the qualitative variables were the strongest. When I was testing in the UK, when initial testing broadly in Japan, and then specific testing on the Nikkei, qualitative variables were the strongest. So because that happened, I review why that may have happened. And a couple of reasons that are discussed. One is that earnings were always expected to be imperfect. So before 1968, researchers said, well, earnings, financial statements really don't tell us anything. After 1968, that changed, but it didn't change from now financial statements tell us everything. It said, well, financial statements tell us half or some approximation of all the relevant information. So given that, maybe a qualitative assessment of the financial statements would be more valuable than trying to get very specific with the magnitude when we're looking at something that is not the end-all be-all. I mean, income is important, but it doesn't tell us everything. The other branch of literature support for my finding that qualitative variables are more useful is findings of a non-linear relationship between earnings and price. So if earnings go up a little bit, we see a large increase, suppose, large increase in price. If earnings go up a lot, we see a little more of an increase, but maybe it kind of trails off. And we might see something funny like that happening with negative earnings. So there are a number of studies that find non-linear relationships, but it seems none of them advocated for qualitative variables. So my suggestion is going to be that because qualitative variables perform so well, and because there's literature that supports a non-linear relationship, that maybe qualitative variables would be something to fill that gap. Okay, so we determined the value of a component of earnings. All right, let's assess meaningful differences. Okay, so we're looking at Japan. We know we're going to look at Japan at this point, and we're going to say, how are we going to determine whether companies that use IFRS are better than companies that use Japanese GAAP? Well, one way you could do it is you could say higher R or R squared metrics. So higher correlation coefficient, higher coefficient of determination, the two are basically the same thing, one's squared of the other, of course. So we could just say whichever sample pool has the higher of these, we're going to say that one is better. Now, there are a number of studies that do that. All right, a number of studies that will be reviewed here say, all right, we see a higher R squared or a higher adjusted R squared. So we're going to say that shows or suggests higher value relevance. And I do that in the dissertation. I'll say, all right, there's a higher R squared in the IFRS firms in Japan. So I'm going to suggest that Japan IFRS companies have higher value relevance. Now, there's no statistical, I guess, way to prove that's commonly used. There are a couple that I'm going to explain. One's the bootstrapping method, and then there are a couple other tests that are conducted. But across all these tests, I did not see a consistent way of proving a statistical difference. The one method that I saw more than once was the bootstrapping method. Okay, so this is a way, all right, let's look at the R and the R squared, and let's do a confidence interval. Now, it's a confidence interval based on just the data that we have. So let's run this through SPSS, and let's say, well, if I had gotten different pieces of this sample data in different manners, and I did it 1,000 times, what would the confidence interval look like? And then if we see that even after we develop these confidence intervals, Japan IFRS is still higher, and it's statistically higher because the confidence interval for Japan IFRS companies is the lowest point on the R squared value does not overlap with the highest point on the Japanese GAAP R squared confidence interval. If that were to happen, then I could say I've used the bootstrap method, which shows statistically higher R and R squared metrics. Now, incidentally, that did not happen. So I resorted to the higher R squared, suggesting better value relevance. There are a couple other methods that I saw one off. This Vong method, equality of coefficients, Siegel-Bittel method. Review and discuss these, but these are not commonly used. Okay, and then lastly, let's look at assessing the small or less than small effects. So this is the idea that there may be a small correlation, or a correlation coefficient may be considered weak if we look at that correlation between earnings and price. And that concerned me initially because I saw essentially correlation metrics that Dr. Sharad Maheshwari would have said, oh, those correlation coefficients are so low, they don't really matter. So you could be finding there's a correlation just by random chance, but anything, I think he said anything below 0.4 for a correlation coefficient is just too small, don't even talk to him about it. And all of these correlation coefficients were below 0.4. So I had to look and see, well, is there literature to support these small correlation coefficients? And there is. There are examples of using comparisons based on correlation numbers that are below 0.4. And one of the justifications for this is what I mentioned earlier, the imperfect relationship between earnings and price. So earnings does not tell us everything about price. So the correlation is not going to be 0.7 or 0.9. It's going to be something below 0.4. And I go into that and go into some of the studies that give a ballpark estimate of what the correlation coefficients might be. Okay, so that's the Ball and Brown, the original study, how it's evolved, contemporary, assessing differences using the Ball and Brown metrics. Let's look at Beaver. All right, William Beaver. What did the original study say? Well, the original study said if we see an increased trading volume at earnings announcement, that indicates value. All right, so investors read the information and then they start trading as a result of that information. Well, that means it's valuable to someone. And if we can control for these investor differences, then we're going to be able to make a comparison between two accounting standards. And I guess I jumped the gun a little bit. What are investor differences? Well, the reason that we see a trading volume, even if there's no information that changes the consensus price, so the consensus price is already set, we have an earnings announcement, there's no change in price. Accounting researchers say, well, there's no change in price, so there's no value in the accounting statement. Well, Beaver said, well, no, there's a bunch of trading volume. All right, why was there trading volume? All right, because we have investors with different views, different risk preferences. And because it's valuable to them, we say it is valuable, it contains valuable information. The one thing we have to be careful about is if we're going to compare sort of two samples with completely different investors. So if we have one sample with a bunch of people who don't care about risk, they say, my risk tolerance is very low. Right? They're all, I guess, similar in that effect. So the earnings announcement doesn't cause them to trade as much. Whereas we have another sample of investors who are completely different. Some of them have high risk preference, low risk preference. Some of them just different ways of processing information. Some of them need things presented in a certain way, otherwise they don't trust it. So if we have completely different investors in that other pool, then they're likely to see more trading volume. So comparing those two could be problematic. So let's pick a sample where we're using the same investors, same types of investors, investing in the same types of companies who are used to getting the same type of information. For example, let's use the Nikkei 225, where we have a similar group of companies expected to have similar investors, similar proportion of institutional investors, similar characteristics in terms of how they process information. So we can use the Beaver study with that caveat. So we looked at the original Beaver study. What did he say? What did he do? What are the contemporary uses of the Beaver analysis? So this is just the Beaver mean difference. So what was the trading volume? And typically it would be a ratio of trading volume. So the ratio of trading volume compared, or trading volume and earnings announcements compared to normal. And if that is higher at earnings announcement, we would say there's a mean difference, like the mean trading volume in non-event period and the mean trading volume at earnings announcement is higher. So trading volume, and then we have the assumption of divergent investor opinions, which I already went into. Contemporary support for trading volume. All right, so these are studies that use the original Beaver methodology, all right, all the way up to 2010, 2012, 2014. All right, so in addition to some historical studies. All right, so that's one branch of the Beaver methodology. The other branch has been regression analysis. So this uses trading volume or trading volume ratio as the dependent variable. And then it has a bunch of independent variables. And one of those variables could be IFRS adoption. All right, so you're looking at 10,000 firms. You have trading volume ratios for, you have trading volume ratios for all of them. And then there are certain ones that adopted IFRS, certain ones that didn't adopt IFRS. Let's use that as our independent variable and see if that can predict trading volume and see how well it predicts trading volume. And let's see whether or not that IFRS independent variable is positive or negative. So does having IFRS or reporting via IFRS, having to report via IFRS, if that's a positive number, that would mean that variable would indicate more trading volume. So we're going to look at a regression analysis with trading volume ratios as the dependent variable, IFRS as the independent variable, and then there's going to be a whole slew of other independent variables. This whole slew of other independent variables are going to be control factors: size of the firm, how many analysts are covering the firm, how are the analyst opinions the same, are they divergent, what's the dispersion there, leverage, what was the reported income, is it a loss, is it a profit? So all these other variables are used as independent variables, and that's going to factor out the effect of those variables. And so we can look just at IFRS. And as I said a minute ago, is that independent variable of IFRS is a positive? That indicates more trading volume and more value. All right, so we've got some studies that say use of IFRS possibly with control variables, and I've got a bunch of studies that talk specifically about what those control variables should be. Okay, so I'm having fun. Taking a little bit longer than I thought. I am done with the literature review and ready to talk about how all this all fits in the methodology. So hope you're still with me. Let's do it. So what methodology did I use after evaluating all of these literature studies? All right, so we've got an overview of the methodology that was used, and I'm going to use these 1, 2, 3, 4 methodologies. All right, so I'm going to test based on Beaver mean difference. So this is trading volume. So the trading volume ratio of earnings announcement to average. And I'm going to see which one is higher. Is the IFRS, is it higher for the IFRS firms, or is it higher for the Japanese GAAP firms? Beaver regression analysis. All right, just like I said a minute ago, I'm going to use the trading volume ratio as a dependent variable, and I'm going to use IFRS adoption, yes or no, as an independent variable. And I'm going to use a whole bunch of other factors that have been identified by the literature as important to use as control variables. Size of firm, analyst following, all that kind of stuff. I'm going to factor that out, and then I'm going to be able to look just at the qualitative IFRS variable. And if it's positive, I'm going to say, okay, so we have a positive effect on trading volume of Japanese companies using IFRS. Indicates more value via the Beaver standard. Okay, so Ball and Brown. So the classic Ball and Brown ratio, I'll explain that briefly, and then the contemporary adaptations of Ball and Brown. So for just the first test, I tested the classic Ball and Brown ratio. I mentioned a minute ago, Ball and Brown did not use regression analysis. They used something else. They used what I term the, what do I term? I term the percent of information contained. So they do a thought process where they say, all right, what was all the information in the entire market? And how much of it would you have known if you had had access to the earnings announcements 12 months prior to earnings announcements? And then they construct a ratio with that. And this is what they hung their hat on in 1968. They said, we find 49, that the earnings announcements contain 49% of all market information. It turns out that that was not statistically rigorous. It worked at the time. It became a seminal study. But when I tried to recreate that exact ratio, I got sporadic results. And I realized that this is why no one has really used it since. But they took the intuition of what Ball and Brown said and proved, and they turned it into regression analysis for value relevance. Okay, so those are the four, and then I'm going to talk about the sample data, the United Kingdom, then Japan, and the data source, Bloomberg Professional Service, Bloomberg Terminal. So for the Beaver mean difference, how do we construct the trading volume? What's the literature support? What's the hypothesis? What's the interpretation? Well, the interpretation is higher trading volume ratio, mean trading volume ratio, and the IFRS pool versus the Japanese GAAP pool indicates IFRS superiority. And then similar process here with the regression analysis. And of course, anywhere you need to drill down, you can just click on these subheadings. So I use simple regression analysis to start. How am I going to sort of compare and quantify that with Parsing correlation coefficient, strength, what's a strong variable, what's not a strong variable. And then that rolls into the multiple regression analysis. And the hypothesis is, as I mentioned, the multiple regression analysis is the contemporary version where we have a whole string of independent variables, and IFRS adoption is one of them. Is that statistically significant, and is it positive? All right, and then the classic Ball and Brown ratio, I explain how it was constructed in the Ball and Brown study. The literature support, essentially there isn't any, and that was kind of surprising when I started reading, and I later realized that it's just because it wasn't rigorous. It was something that they did, which generally served the purpose in 1968. Okay, and then the value relevance. All right, so contemporary adaptations. Okay, so key is going to be the earnings methodology. Remember, I mentioned we're going to have to explain how we calculate earnings surprise. Are we going to do it based on analyst expectation? Are we going to do it based on drift? Are we going to do it based on a naive expectation? And then are we going to use qualitative variables? Are we going to use magnitude variables? Well, I use them all. But my analysis is going to point towards the analyst adjusted variable and the qualitative variables. And, but we test them all in the methodology. Okay, literature support. Yeah, okay, and then there's some sort of ways I'm going to rank these earnings methodologies after I get the results based on which companies chose based on the full sample, not which companies chose. So look at the full Nikkei sample. I explain how I'm going to rank these results. All right, and then this is revisiting the assessing meaningful differences. All right, am I going to just say that a higher R squared indicates better? Yes, I am. I'm also going to do a bootstrapping analysis to see if I can prove that statistically. Sample data. All right, so the United Kingdom was the first step, and this explains how we were looking at the United Kingdom and the FTSE. When we get to Japan, we are first going to look at the Tokyo Stock Exchange. We are then going to look at the Nikkei 225 and sort of summarize some of the support for using that as the testing pool in the literature. There are some concerns. What are the concerns? Relatively homogeneous. All right, doesn't so we may have a difference of industry classifications. That was, I mean, that was literally. It's not just what I decided to test after. That was my main concern, because the literature supports, well, certain companies who think they're going to benefit from IFRS choose IFRS. So if you just compare those companies to companies that don't choose IFRS, then it's potentially a problem. So one of the ways to mitigate that is to test for industry classifications, which I do. Bloomberg data source. All right, so this was exciting, trying to figure out Bloomberg and then trying to call Bloomberg every time I had a problem. They just weren't, they really weren't used to academic researchers on Bloomberg. But I got to the bottom of what I needed eventually. And I was able to learn Bloomberg, and I was able to benefit from thousands of companies that are covered via analyst expectations, and a large number of analysts, and Bloomberg has a method of averaging all the analysts that cover a firm. So I could know what the analyst expectations were. I could also know how many analysts were covering it and what the dispersion of analyst thought was. All right, so that's the methodology. Let's look at the results. So methodology, results. What happened here? So the results are in 4 categories. So there's 2 in the UK. So UK was the first step. Remember, I was going to try to test mandatory adoption in the UK. So let's look at the UK before and after IFRS. All right, before 2005, after 2005. All right, then let's look overall at the UK with the US as a control group. So let's say all the firms in the UK that use IFRS versus all the firms over the time period in the UK that did not use IFRS, and then let's include US firms as a control group. This would have been a little more carefully constructed if I had stayed in the UK, but these are the results. And as I mentioned a minute ago, one of the key results here is that the analyst expectations qualitative variable is strong. All right, it's a good way to measure the surprise earnings, because it turns out to be highly correlated to abnormal price, abnormal returns. So I looked at those 2 testing pools. Then I looked on the Tokyo Stock Exchange, tried to test every one. And then I ultimately got to the 3rd and final step, the Nikkei 225, which is which are the basis of the conclusions in this dissertation. All right, so what did we find? All right, beaver mean comparison. All right, you know what I'm going to have to do, Dr. Credle? This has gone on longer than I thought. I think I'm going to have to do a second run here and pick up with the results and the conclusions. So what I'm going to do is I'm going to stop recording at this point, take a quick break, collect my thoughts, and then I will have 2 videos for you. One will be this one. The second one will be going over the results and the conclusions. All right, so let's stop share, stop recording.